Hello everyone, I'm Dr.A.G.Mythili, Assistant Professor, Department of Commerce with Finance, Dr. SNS, Dr. College of Arts and Science. In this video, I'm going to speak about type of risk in banks. So before going to that, so what is risk? So it is the possibility of something happening bad. So risk involves uncertainty about the effects. In bank, it is the possibility of loss that may risk due to merits, reasons and uncertainties. So risk refers to degree of uncertainty and or potential financial loss inherent in an investment decisions. So credit risk in bank, it is risk that the borrower or the counterparty will fail to meet their obligations. So the bank access the creditworthiness of borrowers and apply risk adjusted pricing, loan limit and credit approval procedures to mitigate the risk, monitoring and stress testing portfolios and key strategies. These are all the factors followed by the banks. So market risk, it is the risk of loss due to changes in market variables such as interest rate, foreign exchange rate and stock prices. So how to manage this? The bank uses financial instruments like derivatives, that is future option swaps, to hedge market risk and employ value at risk, that is VAR, models to estimate potential losses under normal market conditions. So operational risk, it is the risk of loss due to failures of internal processes, system, people or external events such as fraud, cyber attacks and system failures. So how to manage this risk? The bank establishing strong internal control, audit mechanism and contingency plans to handle operational disruptions. Cyber securities and compliances measures are critical in operational risk management. Liquidity risk. So this is the risk that a bank will not be able to meet its short-term financial obligation due to insufficient liquid assets. If the bank does not have liquid cash, so it will not be able to meet its short-term obligations when it comes due. So how to manage this? The bank has to maintain liquidity buffer and comply with regulatory requirements like liquidity coverage ratios, net stable funding ratios to ensure adequate liquidity in stressed conditions. Interest rate risk. This is the risk that changes in interest rate will affect a bank's earning or a value of its assets and liabilities. To how to manage this, the bank manages this risk by balancing the duration and sensitivity of their assets and liabilities to interest rate fluctuations. Techniques like gap analysis and duration analysis helps them to manage this exposure. Reputational risk. So this is the risk of damage to a bank reputation due to negative public perceptions, often arising from failures in customer services, unethical practices or regulatory breaches. So the bank manages this by maintaining transparent communication, ethical business practices and strong customer relationship that helps them to mitigate reputational damages. So compliance and regulatory risk. So this is the risk, that is the legal penalty or losses of non-compliances with laws, regulations or standards. So the bank manages this compliance department and systems in place to ensure adherence to legal and regulatory frameworks such as Base 3, anti-money laundering, that is AML rules and know your customer policies. So the major challenges in banks while managing these risks are cyber security threats. As banks increasingly digitalize their operations, cyber securities emerge as a significant risk, protecting sensitive financial information against hackers and breaches in a continuous challenge due to the sophisticated and evolving nature of cyber threats. Balancing security measures with user convenience adds another layer of complexity. Regulatory changes. Regulatory environment for banks in a state of flux with new laws and amendments often coming into force. Keeping abreast of these changes and ensuring compliances can be faulting requirements, constraints, vigilance, and adoptions. Complex financial products. The innovation of complex products offers bank new avenues for growing but also presents new risk management challenges. Understanding the intricate working of these products, assessing their risk profile and managing these risks adversely damage demand specialized knowledge and skill. Bank must invest in training and develop to equip these teams to handle these risks. Globalization of financial market. As a bank expands their operations globally, they are exposed to new markets and varying risk profiles, including different regulatory, political instability, economic volatility. Managing these diverse or often unfamiliar risk requires understanding of local market and international risk management standards. The challenge is to maintain a constant risk management approaches while adapting to local conditions and regulations. Credit risk management. Assessing the creditworthiness of borrower and setting appropriate interest rates and possess ongoing challenges. Economic downturns, shifts in the market, or unforeseen circumstances affecting borrowers can significantly impact a bank loan portfolio. Balancing pursuit of profitability with prudent risk assessment is a delicate endeavor. Thank you.